It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome. It is Jill on Money. We are the radio show that takes the mystery out of your financial life. I'm Jill Schlesinger, CBS News business analyst, certified financial planner. I am joined by my partner in crime, Mark Talercio. He is the executive producer and also a certified financial planner. This is the show, ladies and gentlemen, where money is not scary or boring. It can almost be fun. I don't want to go crazy, but anyway, we are broadcasting from the Capital One Bank virtual studios. Capital One, what's in your wallet? It is Father's Day weekend. And so that's that. Happy Father's Day to you, Mark, your second Father's Day. This is always a weekend where I feel very sad. I miss my own father and my father-in-law, two incredibly different men, but both of whom were just bright, shining lights in my life. And so do something nice for your father or your brother, whomever is a father. Let's honor the fathers out there, right? Why not? Okay. Just to remind you, if you have a financial question, if it's a tax question, if it's any sort of question that has a dollar sign attached to it, send us an email. Our email address is askjill@jillonmoney.com. That's askjill@jillonmoney.com. Okay. A few weeks ago, I conducted a fun workshop with a bunch of recent college graduates. And we did a Zoom meeting after. And here is this wonderful email from a woman who was on that Zoom call, was a 2019 graduate from college working at a big chemical firm. And she said she's paid off all of her student loans, and she currently has a car loan, $21,000, with 2.9% interest. She writes, I have a 6 to 12 month emergency fund in a savings account. I contribute 16% to retirement funds. Wow. 6% company matching. She's splitting her contributions into a pre-tax 401k and then also a Roth 401k. She's adding to her savings account about $700 a month. And she says, I'm lucky to live in an area where my standard of living is low, about $400 a month for rent, living in a house with two roommates. Mark, $400 a month for rent. How about that? Wow. Okay. Because she's so funny because she's an engineer. Of course, she has a beautiful Excel sheet to track her spending and where her money goes every month. Okay. Here's the question. I consider myself extremely lucky to be able to put so much money into my retirement plan, and I still have $500 to $600 a month left over. I know you say to tackle the big three before moving forward with anything else, but I do feel comfortable having the car loan to help build my credit. If I'm able to put the money towards something else that might result in a higher return than the interest I'm accruing now, let me know. I don't know where to put the money, blah, blah, blah. Okay, she says, I'm doing a mixture of an extra payment on my car loan, putting money into Robinhood or savings. Anyway, so I think this is a great plan. Here's what I would do. You can have a Robinhood account if you want. You can have any sort of online access to any sort of investing account. And that might be, Vanguard just started this brand new robo advisor. It's unbelievably cheap. What's the name of that Vanguard robo, Mark? Vanguard Digital Advisor. I would check that out. Not that I don't like Robinhood, but I love Vanguard and it's so easy. So I would check that out. If you want, whatever that extra money is, sure, an extra payment on the car, then put some money into maybe this Vanguard Digital Advisor. The savings, you got your savings. I think you're good. So that's what I would do. And I wish you the best of luck. And I thank you so much for writing because I love hearing these stories of recent grads who are really all over this, which is great. And by the way, the only reason why I'm saying to make the extra payment on the car loan is that in your savings account, you're not going to earn 2.9% interest. So even putting a little bit extra down on the car loan, it's essentially a better way to manage your extra cash flow than putting money into savings where, frankly, you're going to get bupkis, right? So let's be clear. That's, to me, a smarter decision for you. Okay, here's a question from Anonymous, who subject is buyout package. Okay. Hello, I love your show. I go to your website weekly. I watch and listen. Thank you for what you do. Oh, that is very nice, Anonymous. If you want to follow Anonymous, then do that yourself. JillOnMoney.com. Okay. Anonymous works for a major airline. I have 31 years in. In the past few years, I've made more than I ever had. Last year, $93,000 in overtime and profit sharing. I am now on voluntary leave for 3 months to try to help out my company. And I'm actually making more with unemployment with that extra $600 weekly, and I'm putting it all away. Here's the buyout offer: $35,000 in severance, 2 years of all medical premiums. That's good. 100 grand into an HRA. Travel, past travel as an active employee for a year, 8 round trip tickets, and then a lifetime pass to ride as a retiree. Okay, here's the deal. I go back to work July 1st. It's a 30-hour work week through September as of now. Future outlook, it will be a much smaller airline. Okay. Now, what else is going on? I was about to say 96. Good Lord, Jill. I'm 56 years old, 3 daughters, oldest at university. And I have co-signed for about $80,000 in loans for her. Second, at university, no loans, gotten by with money from us, scholarships, government loans. Third kid, high school, getting ready for 4-year university, about 12 grand and a 529. Husband and I make about 124 grand per our hourly wage. We have a $46,000 mortgage on a home that's worth about 250 grand. We owe $10,000 on a car. That's the only liability. We have about a $4,000 a month budget. I can try to lower it if we got extra conservative. I have 120 grand in a 401k. Which is fluctuating, 10 grand in a Roth. Husband has 100 grand in a traditional IRA, 50 grand in a 401k, 30 grand in cash. Okay. I'm not very marketable because, well, I'm 56 and I didn't go to college. Please note, I'm healthy. I'm eating right. I work out, blah, blah, blah. My husband says I should stay with a job. I'm leaning that way as well. Am I missing something? Okay. My husband says I should stay with my job and I'm leaning that way as well. Am I missing something? You're not missing anything. Stay with this job. Do stay with this job. There is a little bit of a problem here because of the way that this is all structured and your age. You really are better off trying to stick with the airline. And the real reason is that if you had this offer and you were 63 years old or 64 years old, it would work a lot better. But remember, there's a long way to go between now and then. And I think that since you look to be the primary wage earner, that this is important. You've got to stick with this job as long as you can. I lean with you and your husband right there with you. Okay, it's Jill on Money. During the break, hop onto the website, JillOnMoney.com, and do me a favor, sign up for our free weekly newsletter. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and we are here to help you out. We've been spending the last few months answering your financial questions, and most of these questions have been about what's going on during the pandemic, during the lockdown, during the opening up. But of course, there must be other issues in your financial life, and we understand that. Whatever it is, we really would urge you to get in touch with us because we're here to help you out. That's it. There's nothing going on here except us trying to help you guys. But unless we hear from you, we can't help you. So why don't you send us an email, ask Jill at jillonmoney.com. And you can always go onto our website. That's jillonmoney.com. There's a contact button that's on the website. While you're there, there's all sorts of things that you can do. You could check out the resource section. Mark really has beefed that baby up. We might have to change the order around now, Mark, because things are going to start happening where all of the concerns are going to start reorganizing. Anyway, feeling a little bit better just in general, as some of the economic data have improved. So I'm happy about that. But also understand that so many of you have been hurt by the crisis. And so if there's something that's going on in your life and you need some assistance, of course, just let us know. All right. And if things are going really well, that's okay. You don't have to be embarrassed. You can still ask us a question. Just don't brag about it to your other friends. Okay. Okay. We got a follow up question from Henry, who had originally written to us about what to do with a $1.7 million bundle of money in IRA accounts. So this was Henry's 60 and wife is 59. They don't work. Okay. So what he was basically wondering is, in what order do you draw money? Okay. In general, here's the deal. From Henry's perspective, he says, "Look, I know that I've got money that's in a taxable account as well as the IRAs." He says, "But the problem is, I'm trying to delay withdrawing from my IRA in order to defer the taxes, right?" But he says the cash account that they have is only going to last about 4 years. So he is going to need money from the IRA soon. So the question is, instead of withdrawing in the future, chances are to reduce our Social Security income because of taxing. Does it make sense to do it now? Yeah, I guess so. I mean, I have a feeling that if you could just pull the money out a little by little right now, and stay within a tax bracket that's affordable to you guys, that would be great. So maybe you could pull the money out that you need from the retirement accounts and remain, say, in the 12% bracket. If you need more than that and you have to pop up to the 22% bracket, that's okay too. But whatever you draw from those IRAs, it is taxable both at the federal level and state level if you actually are in a state with a state income tax. Factor that in. Don't try to do it all at once, a little bit at a time. And, it's one of the reasons why we really do try to encourage people to use a Roth, because then that money has already been taxed. But when you have a pile of money that's in a retirement account and it hasn't been taxed yet, that's one of the issues that can mess up some of the means for your retirement income. So it could mean that your Social Security benefits get taxed at a higher rate. So overall, I think that is a good game plan, little bit at a time. Try to remain in a slightly lower tax bracket. So whatever that tax bracket is, I think 22% would be just fine for you. Okay. All right, here is a question from Gary, who asks a hypothetical early retirement question. Okay, I work for a small company, 30 people. We're seeing a significant decrease in sales. February and March were record sales months. April was 25% of plan. May is looking worse. Our customers' budgets are contracting. There's not much money for our types of products. The reason I'm telling you this is that I foresee that our company will downsize later this summer due to the disruption in our normal business activity. Our industry is listed as essential, as are our customers, but they're just not generating much, if any, revenue. I'm estimating 2020 will be a very bad year for profitability. I am part of the senior management team. I'm also in the twilight of my career. I will be 62 this fall. Financially, I'm in good shape, but my plan has me retiring from this position at age 65 when I can utilize Medicare and Social Security. I also have a pension from a previous employer that maximizes my benefits if I start to accept those payments at 65. My wife and I could take Social Security and pensions later this year if we needed to. I'm questioning if I should make the offer to my employer to take a reduced salary, fewer hours, or a layoff. My thought is that I am one of the top salary expenses for my company. If the company can reduce expenses on me, then they'll be able to keep more of the lower cost younger employees working. Is this a good, bad, or stupid idea? Do you have any suggestions on what I should propose to my company or how I can help out with the company and my younger colleagues? This will affect our retirement plans, but it won't kill us. We're in the process of building a home on the beach, and that will be our primary retirement home. We will need to postpone this for a while. We're planning on doing some traveling around the country with the RV. All of this will be postponed for a while. We've got 850 grand in our retirement plans, Roth and traditional. Our only debt, $117,000 mortgage on a $650,000 home, and we live in a strong market. The equity is slated to build the beach house. 70 grand in cash and liquid assets. Net worth $1.5 million within the next 10 years, I will inherit over $1 million. This is one of those amazingly lovely emails, and I'm going to sound like a brute with my response. I think it's a lovely idea. I'm not sure I would raise my hand just yet. And here's what I'm thinking. I think it's great as a senior manager, you're trying to figure out how can you propel this company forward. But I might wait. I might wait to see how the next couple of months go. And then I think it's worth saying to the bosses, you're all part of senior management. What are we doing to stay in business? And I think what would be really great is if you could somehow say to everybody that this is what the management team should do to save many of the younger employees. You doing it alone, I think it's kind of nice, but I don't know if it's going to move the needle. So what I would say is that as part of a senior management team, you're running a company, you're going to make some decisions to keep this company solvent. What is the best decision for the company going forward? In many respects, I think about these kinds of conversations in a medical light, meaning that if you're trying to cure a patient, you look at the whole patient and you make decisions about how can this whole body survive this crisis. And if you start making decisions about, well, I don't want to do surgery because I don't want a scar on my chest, that starts limiting. So now if you pull back and say to yourself, what is the best thing to do for this whole body, this organization? And you put the organization first. Keep that hat on as you are going through these conversations. And then I think it's worth saying, instead of you alone, what is the best? And maybe you're all going to take a salary cut. Maybe all of senior management is going to take a salary cut. But whatever you decide, I think that it should be an organizational question. And while I think that it's quite laudable that you are willing to do this yourself, I still believe that it's got to be an approach that all of management is taking together. And do keep us keep us in the loop on this. I'm wondering how this will turn out. Let me know what you decide to do, because that's a really interesting conversation. Okay, it's Jill on Money. By the way, we have a sister broadcast. It's called Jill on Money. It's a podcast. You can get it on Apple, Stitcher, Spotify, radio.com, Google Play, wherever you find your favorite podcast. Jill on Money. We'll be right back.
401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. And we are here to answer your financial questions. If you have one, just send us an email. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. And we'll be happy to help you out. So let's do this. Let's go to Kevin. All right. Kevin writes, my wife and I are in our early 30s in New York City, who until recently had been saving up money as actors in Broadway productions. Oh my God, that's so cool. We're doing fine with the $600 per week unemployment bonus from the federal government, but that boost is slated to end in July, well before we can resume work in our industry. And we need to think about which resources to tap into once we start running out of cash. They've got 8,000 bucks in cash savings. By the way, I heard here that Broadway probably not getting back into business until the spring of next year. Kind of hard to have a big Broadway production with social distancing, right? So these folks are not getting back to work anytime soon. Here are the options. Start racking up credit card debt, something we've always avoided in the past. Dip into our 401ks. Sell off our stocks, which are worth about $6,000. Sell off our exchange traded funds and closed end funds worth $11,000. Sell off our mutual funds worth $3,000. Okay, here's what we're going to do. Number one, sell the stocks. You're going to do 3, 4, and 5. Sell the stocks that are worth 6 grand right now, immediately. Sell off the exchange traded funds and the closed end funds. Sell those immediately. Sell your mutual funds. And so that gives you $20,000. That's all you're going to do right now. And you're going to put it in your cash savings. So now you have 8,000 right now. This is going to be an extra 20,000 right now. Now, I don't know what's going to happen. I don't know if there's going to be another stimulus check or what's going to happen. I don't know if you're going to get enhanced unemployment or not. But what I would really be very clear about is that those 3 options, the stocks, the exchange traded funds, the closed end funds, and the mutual funds, those are all risk assets. And we definitely need you to get that money out of risky assets and conserve your cash. That's incredibly important. So, the thing that's also out there, which as far as the 401ks, I understand that there's no early distribution penalty, remember, in 2020, but let's keep that in the back of our minds. I think that right now, do the 3, 4, and 5. Do not rack up credit card debt. Don't dip into your 401ks just yet. And he goes on to write that none of these options are preferable, but we won't have a choice. Even if we wanted to go back to waiting tables, I don't know if there will be work available in that sector. Thanks so much. I love the podcast, even if thinking about money scares the living hell out of me these days. I know this is a terrible situation for you guys. I am here for you. And so let's get rid of all the risky stuff. Let's build up your cash reserves and stay in touch with us, because there may be a reason that you have to dip into those 401ks. And for everybody listening, remember, there is no 10% early distribution penalty for 2020 from any retirement accounts. Okay. Now, these are for coronavirus related distributions. There is a tax that's due, but it could be spread evenly over 3 years. So that's good. So just be clear about this. And thank you so much for writing. A huge fan of Broadway, and really hoping that you guys can get back to work sooner rather than later. Give us a holler if you need more help on this, and do stay in touch, like I said. Okay. All right. This is Kurt, who's going to be 62 this summer. And he says, I'm considering retirement or maybe forced to do so later this year. Okay. Here's the issue. I've heard both sides of taking Social Security early and later. Obviously, later gives me a larger sum for fewer years. Early gives me a smaller sum for more years, providing I live a long life. Okay. My Transamerica account is saying at 63, I would have about $3,900 per month after taxes, which includes an $80,000 mutual fund, a $30,000 retirement account, 425 grand in a 401k, and then Social Security of $1,900 a month. I would be making more if I retire than I'm making right now. He takes home $3,900 a month. I also work part-time and I make 600 bucks, I guess it's a month, as my side hustle. My wife and I are still raising kids, 12 and 15, and they spend about 5,300 bucks a month. That includes payments to home, car, home repairs, utilities. If all goes well and nothing expected comes up, we can save about 5 to 600 bucks a month, not including my side hustle money. I don't know of another way to make up for Social Security payment until our house is paid for, which isn't going to happen. Once the kiddos are out, my wife and I are going to downsize and pay off the new home or maybe even rent. If I do retire, would it be wiser to find a full time job and make up for Social Security and not take it until 67 or take it at 62? Just having your opinion, ideas, or thoughts would be great. Thank you for your time. Okay, Kurt, here's the thing. In general, the delay of Social Security till your full retirement age is preferable. You're right that it is kind of a bet on how long you live. So the break even is probably into your late 70s. But one thing that I don't think you actually noted is whether or not you claiming Social Security would impact your wife. Does she have her own record? Because if she doesn't, if she's going to claim half of your Social Security benefit, then I think that that's a real argument for delaying and getting a larger benefit. I also would want to point out, and I know where it's premature right this second, that there would be no reason for you to pay down your mortgage. If you wanted to sell the house and rent, that would help you. But generally speaking, here's my 2 cents. If you're forced to retire and you could wait and you could find another job, working until age 67 would be the most preferable outcome for you. That's the reality of it. Okay. If you've got follow up questions, let me know. You're listening to Jill on Money. When we return, we're going to get to more of your questions. But during the break, go to the website. And there you can buy my book, The Dumb Things Smart People Do With Their Money 13 Ways to Right Your Financial Wrongs. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
Welcome back. It's Jill on Money, and we are here to make sure you know everything you need to know about what's going on in your financial life. And also, as rules are changing, and they have changed a lot this year, things that you need to keep in mind. Just want to remind you that, here we are, it's the middle of June. Don't forget that if you have not actually filed your taxes yet, they are due on July 15th. They are coming. This is coming up. If you need more time to file beyond that postponed date of July 15th, you can file an extension. You can file Form 4868. Very easy to do. That will give you until October 15th to file your tax return. But remember, the extension to file, it is not an extension to pay. Your taxes have to be estimated. If you owe anything, you've got to make that estimate by July 15th, or you are going to face nasty penalties. I also got a note from the IRS this week that it is back to processing paper returns that were sent by mail. But here's the note. However, taxpayers who mailed a paper return will likely experience a longer wait time. Can I say that again? Taxpayers who mailed a paper return will likely experience a longer wait time. Those who have already mailed a paper tax return, but it hasn't yet been processed, should not file a second tax return or do not write the IRS to check the status of your tax return or your economic impact payment. In other words, lose my number. That's what the IRS is essentially saying. So this is yet another reason why we try to encourage everybody to file electronically. So much of our lives are actually electronic now. See how this comes back and bites in the tush when you go back to the paper? No, don't do it. All right, let's do this. Let's get to some more questions. Dan writes, I love your show. Thanks so much for putting out so much wise advice at this confusing time. My situation: I inherited a house early on worth about $70,000. It's currently rented out. I have no debt, 10 months of expenses saved up in bank accounts. I want to start investing for the long term. So far, I've put about $28,000 in Vanguard stock index funds, and I've avoided bonds. My thinking is that the house sort of acts like a bond allocation in that it has a steady price and it brings in income. So he's basically saying if bond is called fixed income, therefore real estate is. And so he's using this as justification to assume a riskier allocation in his portfolio. Okay. He says, eventually I'm going to sell this house. I'm going to use it as a deposit on my own house, at which point I would probably buy some bonds to balance my portfolio. Does my thinking make sense, or should I be buying bonds now? Many thanks for the advice. Keep up the good work. You're helping so many. Well, Dan, no, it makes no sense because real estate is a different asset class than fixed income. Now, that said, if you are looking at this in sort of a smarter way, I think what you would say is that even though you've got an investment in real estate, that this investment is going to be used up. So really, this is going to end up being the money you use for your own home, in which case you will only have a $70,000 portfolio or whatever you add to it. So I think that you should be adding other asset classes into your mix. And that could be bond or bond funds. You could use a bond fund like a Vanguard intermediate term bond fund. But I do think that it is important for you to have a portfolio outlook for this money that is really, the $28,000, that this is truly the money that is all the money you have. Because the $70,000 house that is currently rented out, it's going to be eaten up. You're going to be using it. So I say go for the bonds. Maybe as you add more money in, you can add even an international stock fund. Okay. Molly writes, I frequently listen to your podcast and I'm almost finished reading your book. Oh, that's so nice. I like your advice to utilize a CFP who would have a fiduciary duty to provide the best possible advice to me and my husband. I was using the link on your website to find one at letsmakeaplan.org. My question is, what exactly does it mean when it lists a minimum investable assets? I have most of our investment money at Fidelity, and I prefer to leave it in one place. We have an investment advisor through Fidelity at no added cost, but I was thinking about working with a CFP to start thinking more specifically about retirement plans, and that would be beneficial. We're 52 and 54, respectively. Does the minimum investable assets mean that I have to move my assets to the company where the CFP works? Or does it mean they only want to work with people who have at least that much money to manage? Are all CFPs found on this website fiduciaries? Other than location and the asset minimum, do you have any suggestions on how to select one? In the past, we ended up investing through Ameriprise for several years, and we just managed to make the advisor rich and generate a mountain of paperwork. Several years ago, I moved all of our money to Fidelity, and I've been mostly trying to invest using low-cost exchange-traded funds, etc. Fidelity has retirement planning tools that I've used, but as we're getting closer to retirement, I think I'd like a little more reassurance that we're on the right track. Thanks for the help, Molly. Okay. You know what, Mark? I'm going to answer Molly on the other side. Let's go to a break, and then we're going to talk a little bit more about Molly's situation. We'll come back and we'll help Molly and maybe you find a financial planner. You're listening to Jill on Money. The website address, jillonmoney.com, will help you find lots of neat stuff, including links to where you can find a financial planner. Okay, we'll be right back. You're back. It's Jill on Money. We are broadcasting from the Capital One Bank virtual studios. Capital One, what's in your wallet? Before we went to the break, we were trying to answer a question from Molly, who's got a bunch of money saved at Fidelity, and she's using exchange traded funds. And she's now looking for some retirement advice. And she went to letsmakeaplan.org, which is the certified financial planner website. First question was, are all CFPs fiduciaries? And I think as of this fall, I don't think that's been delayed, but all CFPs will be held to the fiduciary standard at all times. Big change, and very important one. Now, the question about minimum investable assets does actually mean what it says, meaning that we're not going to work with you unless we're going to manage this amount of money. So you got to meet a minimum. Now, your question is slightly different. And I think what you may want to do is maybe chuck the CFP website and instead go to a different website called the National Association of Personal Financial Advisors, NAPFA, napfa.org. And the reason I think this is going to be helpful for you is I think you just want to pay somebody by the hour to conduct retirement plan scenarios for you. I don't think you're actually asking for someone to manage your money. You need help with retirement planning. Now, if you really want to do it yourself, you can go check out a paid calculator like esplanner.com. But if you really want somebody, a NAPFA advisor is held to the fiduciary standard, is usually a CFP, but has very specific restrictions, meaning they can't collect commissions, and many more of them would be available by the hour. Now, if you run into a problem, just give us a holler. If you kind of hit a brick wall on that, don't worry about it. Let us know. And what we will do is we will send you a couple of names of people who can help you prepare a retirement plan. I hope that's helpful, Molly. And thanks for writing. Okay, we've got a whole nother hour ahead of us. How exciting. It's Jill on Money. During the break, go to the website, jillonmoney.com. Check out some of my TV appearances. Tell me how you like the backdrop. Okay, we'll be right back.
It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It is hour number 2 of Jill on Money, and we are broadcasting from the Policy Genius virtual studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. During these uncertain times, it's interesting for me to start hearing from people who are actively entrenched in giving people financial advice. And that's why I wanted to talk to my friend and friend of this show, Michael Goodman. Now, Michael is the boss of Wealthstream Advisors. And I really wanted to understand from Michael what was going on, how they were managing the business, and essentially, what was the important lessons that were learned coming out of this crisis? So we're going to start with the basic aspects of what happened during the pandemic meltdown for Michael and his firm. So here's Michael Goodman of Wealthstream Advisors. Here we are, we're talking to you 3 months into this. How has this been for you and for Wealthstream Advisors? Tell us what it was like in the beginning when markets were cratering in the month of March. Were you overwhelmed with people freaking out?
It was difficult. There's no question about that. I would say that we weren't overwhelmed on an inbound basis. We took great efforts to be outbound ahead of that. We were reaching out to clients aggressively over a long period of time. Our goal, have learned from prior crises, is to be very communicative with our clients and to reach out to them in a proactive manner.
So tell us about what kinds of people, when they were calling, what were some of their concerns? In other words, I'm wondering, from our perspective, we had a humongous increase in the number of inbound emails that we received. And I could almost put them in some buckets. Obviously, we had people who were just freaked out and scared, but there were also a lot of people who seemed to be really freaked out by the amount of risk that they themselves chose to take and wanted to know whether to do something different. How did your more aggressive investors fare through this? Were they worried, or was it some other type that was worried?
The majority of the aggressively invested clients were pretty good. They were mostly true to their risk tolerance. Matter of fact, some of them wanted to rebalance at this time, sell bonds, buy stocks. Some of them that might have had some cash on the sidelines wanted to invest. And that was, I would think, for the aggressive investors, more of the predominant response.
Move down into like your generalized growth investor. Let's say you would call that, say, a 70-30 investor is a growth investor, 70 risky, 30 not so risky.
Yeah, even a 60-40, might have a growth mindset for sure, as opposed to sort of a more moderate mentality. This came down a lot to two factors. First, of course, yes, risk tolerance. What I find also, though, is its proximity to reality. And what I mean by that is we are all so greatly influenced by what our anecdotal experiences are on a day-to-day basis. So, for example, if this person had a buddy who was owned a dry cleaning business, and that dry cleaner was completely shut down because nobody was going to the dry cleaner, or a restaurant, for example, this person was much more panicked, much more concerned than another person who had an anecdotal experience of somebody who was in a business that continued on with no problem and had some friends or experiences where everybody was healthy and this wasn't an issue. So trying to get people to back away from those anecdotal day-to-day experiences into the bigger picture was really the goal, and to really understand what the challenge was on a personal financial basis.
It's interesting though, because I would imagine I'm asking you this question, but you have such a different way of approaching someone's financial life in that, with your training, you take a holistic approach, which means you do planning. So I'm wondering if this is not a case of the wrong pool of people, right? Because I know that what you do for your clients is you prepare a plan. And I imagine that if someone has a plan, that person probably has a mindset of, I'm in it for the long term. I know what the numbers are. I know that they're going to be losing years. So I wonder what you might be hearing from others, because I know you have other friends in the industry, and what you imagine people who don't have a plan, how they are feeling. Maybe the insecurity pops up if you actually don't have a plan to fall back on.
What I'd like to say is, while it's true that if you have a plan and you can focus on that plan and keep your eye on the long-term plan, it is easier to get through a period like this. But let me tell you, there are many people that have a plan that cannot stick to it. They way overestimate the impact of the short term and way underestimate the power of the long haul. And they abandon plans quickly in some instances. Whether or not I was able to get people, or my team was able to get people to focus on their plans, was not always relevant, especially in a crisis like this, where it's not just a financial crisis. There was a lot of emotion around health and well-being, and it was harder in this environment to get people to realize that.
How was going through this experience over the last 3 months? How does that compare to being a certified financial planner during the Great Recession? So far, can you tell us how your personal experience in running your business and dealing with your clients, how is it different than what we saw back in 2008 and 2009?
It was very different for me for two reasons. One is working with clients in this period, and two is managing a company of people. I have a lot more people on our team than I did back then. So working with clients, like I say, the big difference here is that it was health issues. And it wasn't just like, okay, there's a financial crisis, the government's going to make sure that we're good and it'll work out. people don't know in a health crisis to the extent of how far it's going to go and where it's going to go, how many people are going to get sick, what's going to happen, how long will it be shut down, et cetera. There was a lot of unknowns, and it was a much more difficult time period to keep people grounded.
And what about you just in terms of, working from home, managing a business? What do you want to take out of this period that might be a change to how you conduct your own business?
There's probably two or three parts to that. The first thing I would say is the obvious one, and that's technology, right? So fortunately for us, we've invested in a lot of technology for different reasons, not at the expectation of having to work under COVID. But I have had the unfortunate experience of being dislocated from my physical space through 9/11, the Hurricane Sandy. So we were kind of preparing for that. But more importantly, is how critical culture and communication and teamwork is. And what I learned is that the seeds that we laid in the prior years of building a team of people that not only are competent and capable, but work well together by empowering them to work together on projects and create that cultural vibe is what really kept us going. The team was genuinely concerned for each other and genuinely wanted to help each other out.
We'll get back to our interview with Michael Goodman of Wealthstream Advisors in just a second. Hey, during the break, why don't you go to our website, jillonmoney.com. There you can bookmark us and you can read all the columns that I've written, listen to past shows, and watch TV segments. Go check it out, jillonmoney.com. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. This is the program that tries to take the mystery out of your financial life. I know it's very hard to do. It's very mysterious times. We are delighted to have a guest this hour. His name is Michael Goodman of Wealthstream Advisors. In this part of our interview, I think Michael makes a fantastic point, and that is it is far easier to get through a crisis, whether it's a personal one or whether it's a pandemic that's out of your hands, if you have a good advisor and if you have a good game plan. Here's more of our interview with Michael Goodman. Let's talk a little bit about another aspect of this crisis that I think is quite fascinating, and that is that we have been hearing from many people who are saying, wow, I just realized that I'm paying 1% for somebody who is not really providing a lot of value. And gosh, I wish I had that 1% that went to my bottom line instead of paying him or her for not doing much. So let's talk a little bit about what you can learn during a crisis as a client about your advisor or your salesperson. What should people be focused on? Because they're going to get their quarterly statements, right? So they're going to say, okay, first quarter was horrible. I got that. They're going to get their second quarter statement. It's going to be a lot better. What should they be looking for as a way to understand whether or not they are getting what they pay for?
Well, I think the most important thing is the communication. And that's one of the best ways to evaluate your advisor. How are they communicating to you? And I'm not talking about just making you feel better or giving you some wonky communication about the markets and making you feel like it's going to work out because they're smarter than I am. I'm talking about getting off the phone and saying, my advisor gets me. They understand me. They know what I'm trying to do or where I want to go. And I believe they have my best interests in helping me get there. And they understand my concerns. And I feel like having them in the pilot seat is going to give me a better chance of getting there.
Let's say that there's someone's listening and they're managing their own money. Maybe the other side of this is, holy smokes, I really wish I did have somebody like that. Vanguard just unveiled a pretty amazing robo with pretty rich tools as well. What do you say to people who want to take the interim step of saying, I don't want to do it myself. I want to put it on autopilot. What's your view of robo or online advisors?
Look, I think there's a lot of solutions out there, and I would never argue that one solution is the only solution for everybody. I think that it really depends on your situation, your penchant for digging into the details and understanding what it is you need and want, and your objectivity. It's really important to be able to be objective. There are a lot of people that probably made some bad decisions emotionally based during this time and might regret them going forward. And frankly, more importantly, are some of the technical elements. There's
Mhm.
a lot of changes in tax law this year and in opportunities in these markets that have nothing to do with how you're invested or your emotional risk tolerance, et cetera, but some basic things that you could be doing to increase your rate of return.
Okay, so tell us.
Yeah, so classic example is tax loss harvesting, right? Which is a fancy term for basically saying, I'm going to sell investment A because it's down. I'm going to register that tax loss, and I'm going to buy investment B that is kind of like A, but not the same to keep me invested. I'm not trying to market time here, but I am trying to register that tax loss. And I can offset other gains in this year and going forward with those losses. That's the classic example, number one.
Okay, number two.
Number two would be a gift that the government gave us, which I'm still kind of trying to figure out why. But they told us that we don't have to take out our required minimum distributions for people that have IRAs and that are older or retirement plans. Yep.
Hold on, let's talk about that for a second. So this
Sure.
year, you don't have to take your required minimum distribution. And you won't have to double up next year because that's what a lot of people thought at first. Like, well, big deal. I don't do it this year, then I have to do it next year. But that's not the case. It's as if this year didn't happen, correct?
That's right.
So now I want to know, should everyone just forego that required minimum distribution?
No, I don't think it's a knee jerk reaction like that. I think you need to think it through. First of all, just for the record, more than three-quarters of the people from the things that I've read need their RMDs to live on.
Mm,
So let's be honest that most people are going to need to take those RMDs anyway. But if
mhm.
you don't have to, you should think about that. And it gets a little complicated now as to the various things you need to consider to make that decision. The first one is if you're married, then I'm more inclined to say don't take it if you don't need it because your spouse can inherit your IRA and maintain that same distribution plan over time. What happened earlier in the year in the tax law that was passed before COVID was that when you pass away and you leave your IRA to a non spouse beneficiary, that beneficiary is going to need to take the distributions within 10 years. It could take it equally or at various amounts, but it's going to have to all come out in the 10th or 11th year. What's really important to think about is what tax bracket will your beneficiaries be in those years? And in some instances, it might be much higher because those beneficiaries might very well be in their peak earning years and they might now have this additional income. So you have to factor that in as well.
But so much of this is like, well, you have to know where do you think tax rates are going to be? You have to know when you're going to die. And I mean, it seems so difficult. So is there any generalized rule of thumb?
If you really want to go general rule of thumb and you don't need it, you're probably better off not taking it,
Mm.
probably. But I really do think you do need to think through some of these other scenarios if you want to maximize the opportunity because tax rates are going to be higher in the future. There's no question about how else are we going to pay for the trillions and trillions of dollars that the government's been pumping into the economy.
You and I have had a long-standing discussion around Roth versus traditional. And we get this question, I mean, so often. And the question I have for you is can you give us a little bit of a rule of thumb even about the Roth versus the traditional? If you believe, and I think most planners, most people in your business believe tax rates are going up, why shouldn't everybody use a Roth?
Well, I surely think the overwhelming majority of people should use a Roth because most people, when they retire, will be in a lower tax bracket because their income will drop. Not all, but most. And not, by the way, not only just rich people, there are even a good example is teachers who sometimes wind up in higher tax brackets in retirement with their pensions. So that's an important distinction. But most people should take advantage of the Roth, especially if you're young. And by the way, I also love the flexibility the Roth gives you, because in the Roth, you're not required to take money out every year like the RMDs for regular retirement plans.
So let's just say, full disclosure, I called Michael like maybe a year ago or 2 years ago because I was talking about somebody that I met at one of my book signings who makes a ton of money. It was like more than $1 million a year. And I said, Roth or no Roth? Because she was offered an opportunity to use a Roth 401k at work. And, obviously she wouldn't qualify for a Roth. And when I had asked somebody else about this, friend of the pod, Ed Slott, he's like, oh my God, no brainer, have to use the Roth. Michael, what was talk about your position on this? Because it's different.
I'll give you an example. So here's somebody who's making oodles and oodles of money, and they're in the highest tax bracket right now, and they're going to retire at some point, and they're not going to have an enormous retirement account, but a big retirement account, and they'll have to take those RMDs. But you know what? They're going to be in a lower tax bracket, perhaps. And maybe they live in New York City right now, and they plan to move to a no-tax state like Florida, which is not uncommon. So there is the ability to get those deductions right now that helps you today. It's a tax benefit right now for you to do that. And when you take that money out in the future, most likely be in a lower bracket. And if you can plan that out, even with the expected increases in tax rates, and if you can project it out and feel good about that, then it will make sense.
We'll get back to our interview with Michael Goodman of Wealthstream Advisors in just a second. Hey, during the break, here's an idea. Why don't you go to the website, JillOnMoney.com, and there, just right there, you can subscribe to our sister broadcast. It's called Jill on Money. It's a daily podcast. Check it out, Jill on Money. We'll be right back.
(401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. This is the show where money is not scary and it is not boring. It is just here for you. We are here to make this a program that makes money, financial matters accessible to everyone. So regardless of whether you have tons of experience or very little experience, this is a program for you. How about that? No matter what. We are delighted that you are joining us. We're in the middle of an interview with Michael Goodman. He is a CPA and also a certified financial planner. His company is called Wealthstream Advisors. And, I think what's amazing during the pandemic and during the financial fallout from the pandemic is that many of you have had the presence of mind to contact us and ask very specific questions about how to take advantage of some of the dislocations in the markets. So early on, what we knew is that interest rates plummeted, and that gave some people the opportunity to consider refinancing. Even Mark did it. I think Mark was already on his way to doing it, but it just so happened that the crisis made the interest rate even more compelling for him. A refinancing of a 15 or a 30-year mortgage, it really is dependent on your unique situation. And that's what we always tell you guys, that's why we want you to call in and we want you to talk to us. We want you to email us because we want to know the details of your life to determine whether or not a refi makes sense for you. Well, in this segment with my friend Michael Goodman, we are going to talk about refinancing, about whether it does make sense for a lot of people, whether a 15-year or a 30-year is appropriate, and Michael's key takeaway for how to survive a pandemic. Hint, it has to do with working. Here's more of our interview with Michael Goodman. How about strange opportunities that pop up amid a crisis like this? Let's talk a little bit about interest rates. Interest rates are way down. Have you been hearing from your clients about refinancing, or are people thinking about purchasing real estate now that rates are so low?
The rate factor is interesting and it affects a lot of people in a lot of different ways. I would say that while rates have come down, savings rates have come down substantially, mortgage rates have not come down as much. And mortgage rates have been at historical lows for a while now. So even if you're going to be able to save maybe a quarter or a half point on a refinance, if you're deeper into your mortgage and you're not going to, really get that much benefit and will now reset the clock on a new term. And after the hassle factor and the closing costs, refinances are not always no-brainers as people might think.
Can you talk a little bit about some of the perils of a shorter term mortgage? Because this is what I've been hearing a lot from people who have 10, 15, even 20-year terms. But actually, when the blank hits the fan, the bigger issue is that they don't have any room because so much of their money is going to their mortgage.
That's right. So I've spoken to some clients in the past where we've looked at a 15 versus a 30-year mortgage, and we've done the math because I've explained to them, you could take out a 30-year mortgage and pay it back at a 15-year pace. Obviously, the interest rate's going to be a little bit higher, but if it hits the fan and or cash flow gets tight, you can revert back to the 30-year payment with no penalty. So it's surely something to consider. I do think that people tend to underestimate the benefits of that flexibility.
I do too. And what's the worst case? So tell me a little bit about somebody who has let's just say, someone who's got a longer term mortgage. You're into the 18th, 19th, 20th year. When do you usually start thinking about, well, okay, maybe this person can pay it down?
We're always looking at the ability to pay a mortgage down versus the cost of the mortgage versus their longer term plans. And if somebody's going to be in a continuously high tax bracket and they're going to actually be able to itemize, well, that's something to think about. Two is the psychological elements. There are people that like to line up paying their mortgages off with retirement. So we're careful with that as well, because psychologically that feels really good going into retirement with that being completed.
Is there a financial case to paying down a mortgage if you're sitting on a bunch of cash and the cash is really getting bupkis?
Definitely. If you're a conservative investor or just refuse to put your money into the market and are sitting on a lot of cash that's earning less than 1%, and there's a guarantee that your mortgage is going to be 3.5% or 4% or even higher, well, then to me, it makes sense to pay down the mortgage if on an after-tax basis, you're going to be net in a worse condition.
What is it about the idea of carrying a mortgage into retirement that you think freaks people out, even if they've got plenty of money? But is it just knowing that you have this obligation?
Well, there's this great transition that people go through that they don't anticipate when they go into retirement, and that is that my paycheck stops.
Mm.
So you're used to every month or twice a month or every other week, depending on your pay scheme, this direct deposit coming in. Once that goes away, even though mathematically you might have enough money in savings and retirement plans, it scares the crap out of people.
Do you find that in light of the crisis and the economic uncertainty, personal uncertainty, that there are some people who are now saying, you know what, maybe I'll just keep working?
I think that that's been underestimated for a long time. When I meet with clients and talk about when do you want to retire, I usually get one of two responses. One is, what time is it? Because they want to retire. They want to retire the next hour. But more often than not, they don't think about it. As a matter of fact, I don't even use the word retire anymore. We talk about when do you want to plan to moderate your income? Or better yet, when do you want to plan to know that you could stop working? Most people, fortunately, that I come in contact with like what they do and enjoy the engagement. More importantly, once they find out that they can afford to retire, they don't mind working as much. I have one client that has his retirement papers in his briefcase. They're completely filled out. They're just not signed and dated. He says that he's in the one bad day away club. He's just waiting for that one day, and he'll submit them on that day.
We'll get back to our interview with Michael Goodman in just a second. If you have a financial question, please do send us an email. So easy. Ask Jill at jillonmoney.com. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money, and we are here holding your hand through the financial fallout from the crazy pandemic. We can help you. All you have to do if you have a financial question is to send us an email. Ask Jill at jillonmoney.com. You know, whenever we have some big, huge financial collapse, and certainly as we were just talking about in the previous segment, with interest rates lower, there's obviously a concern about how pensions are able to actually maintain their targeted returns. For example, if you were hoping you were going to get 4% interest rates and interest rates have gone down dramatically, how safe are pensions? How safe is a pension in a state which appears to be basically going broke? This is what we're covering in the last part of our interview with Michael Goodman. He's going to talk about the safety of pensions and also how to get back into the investment world if you've gotten out at the bottom when you were panicking. Here's the last bit of our interview with Michael Goodman. I know you've got some clients who are educators. We've been getting a lot of questions from people who are part of municipal plans where they are due a pension. Do you fear for some of those plans because interest rates are so low and states are under so much pressure? Do you think that people, I mean, if you have a pension, is it okay to just keep banking on your pension? I guess that's my question.
I do believe, especially from a municipal scenario, that you probably don't have to worry. You should be concerned, maybe. You should surely be aware and educated around this issue. I have some clients right now that are in a union, and that union is suffering from some really bad mismanagement of the funds and never really recovered from the financial crisis. And they are going through the process of applying to the government to modify the pension. So it is a reality. I don't want to imply for a second that it's not. I just think that the governments have a different ability to fund their pensions than perhaps a union or a corporation.
Michael, we have gotten some questions from people who really did freak out in March. They're sitting in cash. How do they get back into the market?
Well, they have to revisit what the plan is for that cash. If that cash is really for a long-term investment, then they should put that back in. The question is how. Maybe because they're pretty gun shy or really feel a little burnt and beaten up from the recent market, they should probably put it in slowly over time, a couple of tranches, maybe 25% every other month or so, something like that. The statistics imply that you should just dump it back into the market because the market goes up way more than it goes down. But the mentality and the emotional bruising might be too great for that.
Yeah. I always say to people, whenever you get back in, that's when the market will go down. So just let us know the day before. We just want to know when you're going. No, I'm just kidding. But that does usually happen. People get really, they get freaked out. And, it's funny when you look at the course of your whole investing life, a day here, a week here, changes they just don't make a big difference. There are also a ton of questions that we have been receiving about people who want to know, should they fund their retirement contributions sooner rather than later? Meaning, I'm going to put $6,000 into my Roth. Should I do it all right now? Should I keep doing it monthly? What's your advice on that?
If your cash flow can tolerate that, you should always put in as much as you can as quickly as you can. Think about it. It's the long-term investment. Who cares what happens in the next couple of months? And that aside, statistically speaking, the market's going to go up more than it's going to go down. So you are always better off putting in your retirement contributions as quickly as possible, assuming you don't have to make some great financial cash flow sacrifice in order to do so.
We also get a lot of questions surrounding the debt and the deficit and how people should be thinking about that. Now, my stock and trade answer is that, now I just basically been quoting Jay Powell from the Federal Reserve. Now's not the time to actually worry about the debt and the deficit. But what is it about persistent deficits and burgeoning debt that investors do need to pay attention to, or just any citizen needs to pay attention to?
Well, I'm no economist, and you probably know some smarter people than me that could answer that question better. But I would say that in the short run, probably not a big deal. In the long run, what's going to happen is our overall government, U.S. health is going to start to suffer from that. And in order to make those continuous payments, it's going to get expensive. And what will probably happen is the dollar will weaken as a result of that. And it could jeopardize our standing in the community. Even when our financial situation is not so good, the United States has historically been sort of the cleanest dirty shirt in the laundry. But going forward, that might not always be the case. So we want to make sure that our country remains strong and financially healthy.
What is it about this current environment that freaks you out?
I think the best thing that I've been able to do is to limit the amount of outside noise that comes in. I mean, I read the paper, I follow the news and all, but I try to stay away from a lot of the excess noise and keep to what are really more of the facts and circumstances. The second thing is focusing on a plan. I think you should have a plan for yourself and your business and your health and your family, and make sure that you're doing things on a regular basis to keep you along that plan. Because this will pass, we will all get back to normal. It's just not happening soon, it feels like, but it will. And we're going to hopefully all have long lives ahead of us that we will get to enjoy.
Thanks so much to Michael Goodman for joining us this hour. We'll link up to his website at Wealthstream Advisors. When we come back, let's finish up with a quick question from you. Remember, if you want to ask us anything, just send an email. Ask Jill at jillonmoney.com. Okay, we'll be right back. You're back. It's Jill on Money. We are broadcasting from the Policy Genius virtual studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. Okay, before we finish up and before you celebrate your Father's Day, we want to get one more email question in from Katie, because I got a lot of questions about this, because I wrote a column for Tribune, which is all over the country, right? And I was talking about the necessity of emergency funds. And she says, you suggested retired individuals have 1 to 2 years in reserve. I wondered why. I've always used the 6-month guidance. Thanks, Katie. Okay, here's why. Because I think retirees have a big problem, and that is if there's one emergency, you can plow through those emergency reserves, and then you got to go invade potentially an investment account, or even worse, an investment account inside of a retirement account. And so I think that because you don't have the power to add to those emergency reserves, that you don't have income, that we could really see you dipping in at the wrong time. Additionally, when you think about when you're retired, think this: I could be reaching into this account when I have a healthcare emergency, and those emergencies are expensive. So I want you all to consider this, really to practice the utmost of a conservative approach to retirement, 1 to 2 years of your living expenses. And part of that has to do with healthcare expenses that can pop up that are not reimbursable. All of these things fall on you, and you have no way to replenish the money that is depleted if an emergency does hit. So, hey, what's the worst case scenario? You got an extra 6 months in the bank. Big deal. You're fine. I promise you, you will never regret having more money than you need in an emergency reserve fund. Okay, that's it. That's the show. Thanks so much for listening. Want to remind you to wash your hands and wear your masks, maintain your social distancing, do something nice for somebody, lift somebody up. If you've got a question, just shoot us an email. Ask Jill at jillonmoney.com. Happy Father's Day. Happy Father's Day to one of my favorite fathers, Mark, the best executive producer in the world. We'll talk to you next week.